And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Hi, and welcome to The Real Investment Show. I'm your host, Lance Roberts, and today is another one of our special interview series, and our special guest today is Thomas Thornton. I've known Thomas for years. He is a fantastic guy. Knows markets better than pretty much anybody else I know. He's also the founder and president at Hedgefund Telemetry, and you can go check out his work at hedgefundtelemetry.com. He also subscribed to his service. He provides a tremendous amount of information about markets and trading. So if you're a do-it-yourself type investor, highly recommend you check out hedgefundtelemetry.com. He's a former portfolio manager, senior trader, and technical analyst with Level Global Investors and Galileo Capital. Tom's written daily market commentary note for a select group of hedge fund managers for years and has offered it to his investors with Hedgefund Telemetry, again, at the website hedgefundtelemetry.com. Tom, welcome to the show this morning. Glad to have you here.
Thanks, Lance. Great to be back.
So, it's been a while since we've talked, and lots of stuff has changed in the market. And this market's been really interesting for me in particular over the last couple of years. We've had the 2022 kind of decline in the markets. We saw, in 2021, we saw the SPACs. We saw a lot of the speculative kind of investing going on that kind of followed all the stimulus checks being put into the markets. Everybody had money to invest. And I was kind of thinking that after 2022, that would all calm down. People would kind of go back to normal. They ran out of stimulus money, et cetera. But no, since 2022, we've had just a rocket of a stock market. Every single dip is bought. There seems to be a perceived idea by investors there's absolutely no risk in the markets. We're seeing just a tremendous amount of leverage through margin debt, through ETFs now, 5x leverage ETFs now hitting the markets. Wall Street always happy to provide product wherever there is investor demand, and investor demand for speculative assets is certainly there. And then, of course, we've got this whole AI trade that's going on as, anything kind of very reminiscent for you and me back in the dot-com era. Anything that has AI related to it seems to just kind of run off to the moon. So just want to kind of spend a little bit today just, kind of talking about the market where it is and things that, as investors, we should be potentially be paying attention to. So just kind of get your early thoughts and we'll kind of go from there.
Well, you covered it pretty well, so we're done.
Well, thanks for joining us today.
Actually, it's pretty remarkable because we've had this, we had early volatility in the Trump presidency, which a lot of people might have forgot how Trump 1.0 was. There's a lot of volatility. There's tweets. There's social media posts that move things pretty dramatically. And that's a feature, not a bug. And I like volatility, and I'm pleased with some of the volatility that we've had this year. The Q1, I set myself up pretty short and covered well in April and got long. Unfortunately, I took some profits a little too early. No complaints this year, but I've been positioned short, and in the last 6 weeks, it's been pretty much a blow off top type of scenario, and it's kind of crazy because I like volatility and opportunities to buy on dips, and dips to me is when we see pullbacks on the S&P or the NASDAQ where we get a little bit under the 50-day moving average. And I think we're at 130 plus days without the S&P closing below the 50-day moving average. Yeah. And that's just basically, a simple way of looking at things the way I see it. And it's become much more narrow from the standpoint of if you're related with AI and you're doing circular deals and there's, it's a bull market for announcements more than revenue. And so it's difficult for me in a market that just sort of grinds higher. But we are seeing some signs of deterioration out there in the markets, and we'll go through that a little bit more.
Yeah. And again, I think that is an interesting note because, you take a look at the number of stocks as an example, just the number of stocks above their 50, 200-day moving averages. Those are declining even though markets are still near their peak. We're slightly, and the day that we're speaking here is, markets are down, 70 basis points. And it's like, oh my gosh, the markets are, I had a guy, I was down in the gym and I was getting ready to leave the gym. The guy says, get upstairs and get to work. The market's crashing. I looked at my phone. I was like, it's down 70 basis points. I mean, that's not really a crash, but that's kind of the sentiment that runs around in the markets right now. The market should only go up.
Yeah, well, that's the way this market is. I mean, everybody's all in, and you have retail that's led this move higher, and kudos to them, and they've been right. Mm-hmm. But everybody's in the same things. They're levered. It's concentrated. There's a lot of dependency on these AI names to continue upside momentum, and we're starting to see. I mean, last week we had a new high in the S&P, but we had 8%, 7 or 8% below or hit 52-week lows versus highs. And every sector except technology saw a decline or more new lows than highs. And to me, that is really concerning. And I've seen this, I've been through, every type of market, from the early 90s. And I even was, I was an intern during 1987. Had no idea what anything was going on, but I worked at Drexel and I gave people fills on their positions. And, I heard grown men crying on the phone. I was like, oh God. And then I was like, this is for me. No, but
funny story.
That's real fear. And now you just have a fear of missing out. And so every little minuscule dip gets bought.
Yeah, no, and that's, I was going to say it was a funny story because you and I were both interning in 87 when the crash happened. And I was working at a bank, and at the bank I was working for, we were working back in the Treasury Department, matching books to CDs, et cetera. And of course, crash is going on, and my boss blamed the entire crash of '87 on me just as a joke, but I didn't know better, so I thought I had done something terribly wrong and I was going to lose my job. But it's very interesting about, and again, that was just a 2-3 day event, and it was over, and the markets went back up, and then. Now you look back on a chart at 1987, it barely shows up. It's like, it was a major deal then. And today you look back at the chart, it's like, oh yeah, there's that little blip that was 1987. You've got a lot of charts I want to get that we'll get into today. And I don't want to jump ahead of you, but in your chart run, do you have anything I wanted to touch on, just to ask you about earnings real quick? Is there anything I'm going to front run you on if I ask you about earnings?
No, go for it. I'm open. Let's go.
Okay. Well, just from a standpoint, so I mean, when I look at like forward expectations for earnings going into next year, they're very high. And and if you take a look at like Goldman Sachs and others, they're coming out with this idea that earnings growth for AI for the Mag 7 is going to slow down, but yet that slowdown in earnings is going to be offset by a very sharp rise in earnings for small and mid-cap companies. My concern is that small and mid-cap companies are much more economically sensitive than the Mag 7. And there's a lot of bets being placed on this kind of forward expectation for earnings growth that may not mature unless we get a really strong economic acceleration next year to help support that. But that's where I'm running into a bit of a challenge thinking-wise for next year is where is that economic acceleration going to come from? I mean, there's a lot of hope this is going to come from AI build-out through, data center construction, et cetera, and that's certainly going to be a big part of that. But I don't know how you generate the economic growth rate needed to support, basically the Russell 2000, right? That's where it seems to be a bit more of a challenge on outlooks.
Yeah, I think that, one thing we always have to remember is that Wall Street always projects earnings growth for the next year, and usually it's around 10%. Price targets are always about 10% higher. And I could see broadening out in the market. And the broadening out in the market is also most likely going to come from a lot of sectors that people aren't really focused on. I think energy looks like a sector that could work. Consumer staples just hit a new low. Materials hit a new low, and that also has a bit of an inflation component in there as well. So I think that there's going to be. Hold on, let me turn my squawk down here. Bill Maloney at Bloomberg. So I think we could have some. I know live. I got screens everywhere here, but I think there's going to be opportunities to buy some things and make real money that are already beat down pretty hard and really have been out of favor. So I'm not, perma bear. I'm not a perma bull or anything like that. I'm just more looking for opportunity as they arise. And one of the problems that the market has is the concentration. So if you have 10 stocks that are 40% of the S&P, and 490, you those 10 stocks go down, it's going to drag the S&P down. I think that's going to be finally the issue for passive investors, where they're going to have to look for more active managed ETFs and financial people that are going to give them ideas that are outside of what has already worked.
Yeah, and I want to talk a little bit about you made the comments you made about energy and staples, et cetera, maybe being an opportunity next year. I absolutely agree with you 100% on that. And that's something that, we're looking at here in our shop as well. But that also kind of because, sector rotation is a real thing, right? I mean, when things get too extended on the AI trade, eventually money's going to rotate somewhere else. And particularly if AI comes under pressure next year, if all of a sudden that we don't start to see some fruition in some of these predictions about AI revenue generation, profitability, et cetera, that and or even a rotation out of the Mag 7, it's got to go somewhere. And there's a very compelling argument for staples, which, as you noted, is at a low relative to technology as an example. There's some very good, compelling companies out there, good, fundamentally strong companies, very beaten up, and could provide a good bit of opportunity, not including the dividend yield that a lot of those also spin off on a total return basis. So, yeah, absolutely agree with that. But that could coincide with a broader sell-off in the markets. In other words, markets aren't doing that well at the headline because of what's happening with the Mag 7, but actually doing pretty well underneath the surface as that bottom 490 starts catching some rotations.
Yeah, I think one of the problems is when you buy stuff that's oversold in an overbought index market, it gets tricky because if those big names start to fall off, and I think that we have. I think we have some of the Mag 7. I think 3 out of the 7 are down after earnings. If we start to lose Nvidia, which is really the king, and just the real concern I have, and I'll just jump right to this. Everybody says, oh, the valuations aren't as bad as 2000 or 99, 2000. But to me, it's the market cap concentration, and the market caps are so big. I mean, $25 billion each point for Nvidia's move is just, that's a lot of market cap. And to go back and to say, well, Cisco, it wasn't trading at the same multiple of Cisco, but Cisco had a $600 billion market cap, and that's a 24-point move in Nvidia to wipe out the entire market cap of Cisco at its peak,
right,
which is just nuts.
Yeah. Well, but you bring up an interesting point. I've touched on this before, on our show here, talking about passive indexing, and this is, one of the conundrums that I wrestle with, which is everybody now, we've taught everybody just to buy an ETF, right? Just go buy ETFs. It's great. Just you get a whole index and you just ride the index. It's fine. Well, the problem is 40 cents of every dollar that you buy in the S&P index goes into those 10 stocks. So what causes an eventual reversal where you get people to start selling ETFs? That seems to be one of the things that we've got to figure out, is if we're going to kind of predict when this market, kind of this bull market cycle ends, this part of the secular bull market ends. We've got to figure out what causes investors to start selling ETFs, which then creates a reverse kind of loop that's occurred where, buying ETFs causes those 10 stocks to go up, selling ETFs causes those 10 stocks to go down and drag the whole market with it. What causes that? I mean, what is it going to take to get investors to start really realizing the risk that they're taking?
Well, it takes time, and there's always the markets do this jiggy jaggy on the way down, and there's always the this is the low type of thing, and that happened in the tech bubble into 2001. You still had people that believed that some names would come back, and they didn't, and it took 10 years for some of the big leaders to regain those old highs. Some haven't. Intel, Cisco, those haven't hit, gone back to the old highs. And one other thing about 1999, and everybody says, well, you got to have the blow off top like 99. 99, the last quarter, you had this Y2K panic buy that pulled forward all the hardware technology because everybody was afraid that their computers were going to shut down with Y2K and, Microsoft not, setting the right date. I mean, so you had this huge pull forward, and maybe that's happening with AI and Nvidia and a lot of times in technology, there's double ordering, triple ordering, and all these CapEx, circular deals, maybe those will, not come to fruition. That is something that is important. And the other thing is the data centers need electricity to power them. And I think that the data centers are going to be finished before the power is actually there. So you have a lot of people that are, really bullish on uranium, and I bought uranium stocks in March, and everybody was like, "Oh, good luck," those, and it turned out to be really pretty good. I still have some, and I'm just holding on to the smaller positions right now. But that's the disconnect that I think people are going to have to start to realize, that these companies are going to say, hey, whoa, we don't have the power to generate these data centers and turn on the lights, let alone the bazillion Nvidia chips.
So, Tom, I don't want to monopolize all of your time today. You've spent a lot of time putting together a very nice presentation for us to kind of go through some of the things you're looking at in the markets. So let me just turn it back over to you, and we'll bring up the first slide. Just tell me when you want me to change slides, and we'll go from there. So let's start with bullish sentiment. What's your point here?
So I track investor sentiment, and I was really fortunate that at my old fund I got to know all of the various sentiment polls, and I was good friends with Ned Davis and that group, and they loved the daily sentiment index, which you can get the raw data. It's kind of expensive, but what I've done is I've put it on charts, and I have it here. And basically the lower part of this is the market sentiment that you're looking at. And it's currently at 75%. And when it's above 70, I call it the elevated zone. When it's above 80, that's an extreme zone. And one thing about sentiment is that it's a condition and not necessarily a trigger. And back in April, you can see it got down to 10%. And when, it's easier to make bottoms than tops. And it can stay elevated and in that condition for a certain amount of time. And there's a red line in there too, that's the 20-day moving average of bullish sentiment. So we're still elevated with market sentiment. And that to me is, it's getting late, and it can stay elevated. It can stay depressed as well. And I track from, equity markets to bonds, currencies, and commodities as well. Every day we get this data. And I think the charts do a pretty good job of laying it out.
Yeah, no, sentiment's always a very interesting thing. And again, is that, sentiment does stay overbought for a very long time, and particularly when you're in a trending bull market. Bottoms are great when sentiment gets really, really negative, like we saw back in April. That's pretty much a really good opportunity to put capital to work. I mean, it doesn't mean that you buy everything, but there's generally when you get, and we have a lot of sentiment gauges that we track internally as well. And back in April, those were hitting readings we hadn't seen since really the the financial crisis, hitting some of those lows.
Yeah.
And it's like,
Agree.
you cannot not buy here. Yeah, it may go down a little bit more, but when you have that kind of negative sentiment, that's generally a really good opportunity. But to your point, it gets a little more challenging when you're in a kind of a trending bull market, because they can just stay that way for a long time. And you're just like, hey, markets are going to sell off here, but when? Right? That's the question.
Yeah, it gets tricky, but I think we have the start of if tops are a process, I think the process is really starting here, and it's lined up to where you have things all stretched on one side. So we can hit the next.
Yeah, we're there.
Okay, so this, one thing I track, and I use DeMark indicators, and you'll see those, 9s and 13s are the significant numbers. The red ones are the sequential, the purple ones are the combo. When you see those numbers, you usually will get a price reversal or at least a stall after those, and it takes 10 to 12 days on the dailies, and maybe 6 weeks on the weekly. So this right here shows the S&P was under 20 times earnings back in April, and that again, that to me was a level where I was pretty confident, buying and shifting to the long side. And so it's trading, and I use the Bloomberg best PE ratio, and it's trading at 25 times earnings. That's expensive. That's not necessarily where you want to be a buyer. The NASDAQ 100 is trading at 32 times earnings. I'll go through a couple others, specific names.
Just real quick before you jump off, just for our audience, could you just hit the real quick highlights about the Tom DeMark indicators, what they kind of measure and what they mean?
Yeah, the thing that Tom DeMark, who was just recognized by the chartered technicians for a lifetime achievement, he created these indicators with Larry Williams that basically track market exhaustion, and it can work on the upside and downside. And he did this in his garage in the late 70s on paper, pre-computers. And then he always told me this story that, the fire department would come over and say, you've got too much paper in your garage, it's going to catch on fire. But he transferred this to computers, and they tend to work pretty well. And when they don't work, it's also indicative of the type of trend you have. And I can show that. I'll show that on a daily chart of the S&P in a second. But bottom line, with these elevated multiples here, and it's been margin expansion leading the way. So I think that we need a little bit more E in the PE ratio let's just even things out.
Yeah, I agree with you. And speaking of that, when the S&P is within 5% of all-time highs and 8% of 52-week lows versus highs, what's that telling us?
Well, again, last week we saw, the S&P hit a new high, and you had about 8% in the S&P hit new 52-week lows. And this was actually sent to me by one of our subscribers, institutional subscriber, that I saw this study, and I was like, well, those X's seem to work pretty well at these particular levels. They didn't hit every single top, but that to me was something worth sharing, because this last move up is so steep, and if that's not a blow off top, I really don't know what a blow off top is, especially with everything narrowing so tight.
Yeah, well, you and I are both trying to figure out that question, but we're seeing that. But we're seeing this a lot. I mean, we were talking about speculative risk earlier, and the number of people just chasing, the most speculative stocks higher, the ones with I posted a chart the other day in our daily commentary talking about the number of stocks that have negative earnings and negative fundamentals versus positive fundamentals. Or they shouldn't be outperforming, but they are. And you're seeing, and as you show here in your next slide, the most shorted baskets are just doing fantastic.
Yeah, there's two ways of looking at this, and going back, you could see, but in January on the daily chart, you had exhaustion signals, and then the market started to fade, and in April we had buy signals down at the lows. So I, just like you, we look at 100 different indicators at different times, and one of the nice things about technicals is that they tend to do the same things over and over. So when you have all those things lining up together, from market sentiment to this, where back in April, Goldman Sachs, their prime brokerage data was saying that the hedge funds were shorting the tariff announcement, Liberation Day, and that gave me hope that shorts were going to get trapped. And I got the 13 on that. And now the thing that is really kind of interesting is that we're getting a lot of them towards the highs here, and that is starting to fade. And on the one on the right is the Goldman Sachs most shorted tech basket. And that one had several 13s. And again, some of these 13s didn't immediately, see a pullback, but some stalled. And that was sort of running out of buyers, and then more buyers showed up. And the second part of this is, besides shorts getting, having to cover and getting squeezed higher, is it really showed the speculation of buyers buying some of the lower quality names, no earnings, valuations were ridiculous, and reasons why hedge funds were short them, they just ignored and ran them higher. But now we're starting to see those drop, and they're down today. The tech basket is down 4%, and so that, to me, the most shorted basket's down 4%, and the and the tech is down 1.5%. So you have a lack of shorts in the market right now, and if you don't have shorts, that could cause more problems, because you want shorts to be the natural buyer. So when you have pullbacks, those shorts are there, with demand to buy, and if you don't have them, it could be more of a vacuum lower.
Right. And we've kind of seen that. We saw a couple of Fridays ago, we saw the market sell off 2.7% in a day. And, it's very likely that, those type of days where we see 2% plus days, there's just going to be a buyer's vacuum there, where sellers are going to start looking for a buyer, and the buyer's going, yeah, I'm here, but I'm 2-3% lower than where you are currently on your price. And I think a pickup in volatility is going to be something that we have to start living with. But let's talk about the Mag 7. You got a couple of really good charts here on the Mag 7 as well.
This is another one that, just going back on the left side, you had a buy signal 13 on the absolute low in April. That yellow line that you really can't see, but that was the wave 5 price objective, and it nailed it right there. And these are like DeMark wave objectives that he created, and I'm not going to go into all the details of that because we'll lose everyone here. But yeah. Here's one of the things that's been challenging, is that you see several 13s that just stalled things out for a number of days, and saw minor pullbacks. And that was indicative of the type of trend. And that red line is the 50-day moving average. And it's rare that you have a market that doesn't go under the 50-day moving average for this long of a period. And this last move higher, you had 13s now on the highs, the wave 5. And then you go to when I get this type of action where the dailies aren't giving you the pullbacks that you desire, and it doesn't have to be 1987, a crash after these signals, but it stalls people out, and then the buyers came back. But on the weekly, you now have both the combo, which is the pink number, pink 13, and the red 13 is the sequential. Those are triggering as well, and those are fewer and far between type signals, and more intermediate term signals. So they were evident down in the close to the lows in 2022. On the end of 2021, you had sell signals, and they work both sides. And that 9 in January, or excuse me, in April, was a level that we bought as well. 9s are sort of the shorter term type signals that worked well. And one of the, I guess, predictions I had was the S&P would trade under 5,000 this year. I don't do the end of the year dance like the strategists on Wall Street because I just so much can change. But
Sure.
I said under 5,000 would happen, and it happened in April. So the Mag 7 is overbought to say the least. The RSIs, I use a 9-day RSI. It's bubbled up there when you see that 81 on the weekly. That's elevated.
So we can flip that over and just look at the S&P 500 dailies and weeklies as well.
Yeah. So same story. We had 13s on the lows in April. Actually, that 113 was a higher low. And then as you see that red line, we haven't closed below that level since April, and that's to me pretty remarkable. So the other 13s here, again, some people say, oh, they don't work, they don't matter, they don't this and that, blah blah blah. I get it. I've been doing this a long time. I've used Tom's work for 27 years now.
Mm-hmm.
And on the weekly now, you also have exhaustion 13s and a 9 there as well. And going back, and you think that is a blow off top type of move. You've just uncorrected for more than 2 weeks, and to me, that's unsustainable at these levels.
And same thing for the NASDAQ, right?
Yeah, same thing. I mean, really, we're just getting all the same signals on the daily and weekly. So, and I post all these every day, and I feel like it's a broken record for many of this, but it does matter.
Right. Well, no, and look, this is, the important thing. People look at technicals like, oh, well, that signal was wrong that one time, or it was wrong these 2 times. That's not what, there's no technical indicator. I've never found a technical indicator that's 100% perfect, right? And, there's things that occur in markets, sentiment, action, whatever. And sometimes technical signals don't give you an exact reading, but they give you a good idea the majority of the time about how to manage risk in your portfolio. And again, I was reading a very interesting article about Paul Cohen over at Point 21 talking about his traders. He says, my very best trader, he's right 55% of the time. The rest of my traders are right 45% of the time, and they make money. And that's the whole point about technical indications, is that it's not about being right every time. It's about being right a majority, more than half the time, right? If you can be right more than half the time, you're going to make money. You're going to lose money sometimes, but you're going to win more than you lose.
I think that's really important. And that's why you and I both look at so many different indicators. And when they line up together, it's telling you something. And it's hard for me to get 100% of all my indicators lined up together and to take, a position either long or short. So if I get to 70%, and I'm not quite there on all of them, I might make that trade. So I don't, wait for the perfect setup, because that never happens. But 70% is usually where I'll start to, engage.
All right, well, let's talk a little bit. Let's talk a little bit about valuations real quick. You've got an interesting chart here on Apple and Nvidia.
Yeah, look, Apple's, these are the 2 most owned stocks in the U.S. market, probably the world, and at 32 times earnings, Apple's had really pretty decent earnings, and the stock still went down. And their guidance was better than expected as well. And it's trading at 32 times earnings. It was 35-ish just before earnings, and that's elevated for Apple. And sometimes it's like, oh, well, that doesn't seem that high, but for an individual company, it's important to look at where they typically trade. And I was short this in April, and I bought, I said to everybody, I said, if we can get this to move down to 25 times earnings, I'm going to cover it. And we got a little under that, and so it worked out. Nvidia, which they've got blowout earnings. Everybody knows they have blowout earnings. They've got, a bazillion deals out there with everybody. It's trading at 45 times earnings, and the steepness of these is multiple expansion, and so it should level off as they report real good earnings. But if you go to the next,
Yep.
where are we? We're at, oh, so here's AMD. They're reporting tonight, and this is one that caught me. I was trying to buy this one in March, April, and it was trading. I thought it was really cheap at these levels, and I was shaken out of this one too early. And it was 40 times earnings just a couple, 3 weeks ago, and now it's 65 times earnings, and that's all on these deals that they're doing with all of them out there. So I think the bar's real high. Like, I'll look at this and I'll say the bar's real high for them right now. Broadcom on the right is also seeing huge multiple expansion. Their earnings are good, and some will say they're great, but they're still trading at 53 times earnings. That's elevated for them as well. And they have a lot of runway. They tell everybody about earnings. So let's go to the next ones, and because these make no sense.
I was hoping you were going to get to
I
Palantir.
like the ones that make no sense.
Yeah. I was hoping you were going to get to Palantir. Go ahead.
This is Palantir. I grabbed this yesterday. It was on my note yesterday because I did an earnings preview. I'm short a little Palantir. But 313 times earnings, the highest price to sales in the market. And the CEO was on CNBC today, and I didn't watch it, but he was railing against short sellers. And there's only 2% of the float is sold short, and it has less than 1 day to cover. So it's really not about the short sellers. I would tell the CEO, and I always get nervous when a CEO. I would be nervous if I was long, if a CEO's railing against the short sellers, because he's obviously very paranoid about his stock. Tesla, what can you say? It's trading at 281 times earnings. They've got the big vote happening with his trillion-dollar comp. Flying cars are being rumored now. We still are waiting for the driverless robo-taxis, which I've done a lot of work on Tesla, and they may be improving, but they're not at level 4, which in Texas you have to be at level 4 autonomy. They're still at level 2 autonomy, and there's a huge process to get certified and approved. It takes time. Waymo's doing really well. I'd be more, I've been in Waymos in California visiting my daughter, and they work, and you feel pretty safe about it. And safety, to me, is the most important aspect of getting in a car without a driver. And so rushing something with less technology really poses a risk. So if they do, take the driver out and it's truly driverless and they have an accident, it just gets sent right back. And $1.5 trillion market cap for this, based on all these things that don't work yet or don't exist, and flying cars, which it's crazy. So
if you're level 2 on robo taxis, I'm not even going to consider getting in a flying car.
If you've been in a Waymo, and I took 5 rides in a Waymo last time I was out there, it's remarkable. And it's not like herky jerky and weird or anything like that. They're a little slow, but they work, and they're just everywhere in Los Angeles and other cities. And look, they're doing well over 1 million rides per month, paid rides. They're not making money on it, and the whole thing, the Tesla bulls and bears. Tesla's technology is cheaper versus Waymo's. That's true, but it's also way more safe.
Yep.
That's my little joke there. Okay, next, let's go.
Yes, we're there. Concentration.
Okay, so we talked about this. 40% of the S&P is in 10 stocks. I think Nvidia's close to 10% of the index now. So again, it's going to take a lot to keep this, keep the plate spinning, and the mega caps moving higher. So that's what we have to watch. Okay, so next, active managers, they're all in. They're at 100%. So, I like to see it when they get, when they get down into under 50%, like they did. They were at 40% in April. That's sort of my idea, that you want to start looking at that. Now it's elevated, go a little higher maybe, but still 100% is.
Yeah,
they're all in.
I actually have a chart I run. So this is the National Association of Investment Managers survey, and I run a chart where when allocations are above 97% and when allocations are below 30%. And what's interesting is that almost without fail, professional managers are buying tops and selling bottoms. So
Yeah,
it's amazing
human.
how
they're human. I've worked for institutional firms. People make the same dumb mistakes. And that's generally also, it creates a certain amount of demand. So when, and supply. So you have the future sellers out there because you've had so much inflows into the market. And that happened in 2021. Remember those huge inflows that we had turned into sellers throughout all of 2022. So now we have that risk of people unwinding some of that long exposure. And again, when they're down at 30%, they're going to want to buy back eventually. And I think that if you can measure it at that level, then, I'm with you.
Yeah. Households, kind of same.
Okay. So this one's, I grab stuff from everyone, and I give everybody credit, of course. Bank of America, household equity exposure, since 1945. It's the highest ever. It's probably a little higher than 31%. And this one is on the right is kind of interesting because it's a ratio of levered ETF versus M2 money supply. And when it gets above that 5 ratio, it's more greed. So we're seeing a lot of, and I have more on levered ETFs on the next one, which is nuts.
Wow.
So my friends at Elliott Wave posted this one, which I didn't realize is this much, but 33% of all the ETFs are using leverage out there. That's a lot.
Yeah.
I mean, considering, in 2021, at the end, they were using 11%. And then in 2022, probably early 23, it's 5%. 33 is a lot.
Yeah.
So it's a lot. And you saw the 5 times levered ETF that people are, if you have a 20% drawdown in the actual issue, you're wiped out. Game over. Those will cease to exist. And so people listen. I'm friends with Matthew Tuttle, who's a great guy, and you should definitely get him on your show. He's one of the ETF issuers that does some of the levered stuff and some of the crazier levered things. And he's giving investors what they want. He's not telling them, this is a great idea. He's not selling it. He's just saying, if you want triple levered Tesla or double levered Tesla, have at it. And it's all run on a computer generated program where he's not, at risk. The investors are at risk.
Right.
So the next one there is the AUM levered ETF AUM growth, and it's almost $160 billion. That's a lot of levered ETFs. And so when you add it all up, it's nuts. So this next one,
short-term options.
If you just listen to CNBC or Bloomberg, all you hear all day are these people that are coming on and saying, don't trade stocks, trade options, and remember, you used to have to fill out a form that, trading options, I had to be qualified for it. Now my dog could get, qualified for trading options, and maybe almost you could get a loan for a house back in 2004. for a dog that,
Right.
it's a deceased dog, even at that. But the bottom line is the zero data expiration options are, notably more. And when I trade options, I I'm looking, since volatility is so low, I can look out a month or two and get actually, almost similar pricing. So I think having some hedges right now makes a lot of sense. And then, I mean, and oh, well, maybe there's put buying in there. No, it's call buying because, this Goldman Sachs chart just showed, 40 million average on the last 20 days of option trading. This is, a little, maybe a little older, but bottom line is
Yeah,
people are buying calls
nobody's buying
every
puts.
dip.
Nobody's
I
hedging.
mean, hedging, what is that? No, nobody does any hedging. So the next one is something that it's really basic, and people can replicate it. And I look at this and think, it's almost too simple. But it's the percentage of stocks above the 20, 50, and 200 day. So 20, 50, 200, and when you get oversold under 20% on the 50-day, the percentage above the 50-day and the 20-day, like we did in April, that just filters into the technical ledger on the asset side, because that was another indication that we were overdone on. And so here we are, the percentage of stocks above 50-day. This one is a day or two old. I think we're at 39% now, or exponential moving average. So it's like 60% of the index is under the 50-day, and we're still 2 to 3% above the 50-day, which
Right.
is nuts, and says a lot about how narrow this market is. So the bottom line, people can replicate this. It's very simple. When you get down to these super low levels, that's a really good indicator of fear, and a time when you can start to look on the buy side. So this is one of my, what is it going to take type of thing. So the last one here, that if you pull it up here, this is another one that's worked really pretty well. It's the 5-day moving average of the equity put call ratio, and people look at the put call ratio and every day, and they can see like these super low levels. But I like to look at it on a 5-day moving average, because it'll eliminate some of the let's say expiration noise or one big trade, which can do that. But we were just at 0.5, and that there is when you have way too much call buying happening, and it's starting to lift a little bit with some of the weakness we're seeing outside of the Mag 7. And again, if you look at the most traded options, it's usually Nvidia, Tesla, Palantir, the same group of usual suspects. But when this spikes higher, I want to be a buyer. And it didn't get to the levels I truly hoped in April. And as you see right above that little red circle, there's a 0.84. And that was kind of like the peak high there. And the reason it didn't get high enough is because that pullback was so short. We didn't really have like the other periods where you see it spike above that dotted green line. And so I want to see people buying puts like they're calling their insurance agent and saying, look, I need insurance for my house. My house is on fire. What can you do for me? And click, but I want to see that type of fear. And a lot of the stuff right there, and that's another one people can replicate really pretty easily on stock charts. But I show this on my site all the time, and I think it's valuable. And it says that we're not, we're not done going down if this market is going to correct.
Right. And so, and that's kind of the thing, I guess, to kind of bring all this together is, so we just had 6 straight months, of upside in the S&P 500. That's doesn't happen very often, but it does happen. And there have been longer stretches. We've gone 7 and 8 months. But, typically once you start getting to 7 months, 8 months, you're really starting to push the stretch of the run of the market. And essentially all you're saying is you kind of just run out of buyers. Everybody's bought, everybody's in, and something happens, there's an announcement, whatever it is, and some sellers show back up into the market. So, but we're also in the 2 strongest months of the year. November, December tend to be very strong months. So kind of how are you positioning, given all this data we just went through, kind of how are you thinking about maybe how this year ends? And then more importantly, kind of what are you thinking like next year is going to be like? I thought this year would be a lot more volatility, which we had April. Yeah. But I didn't think we'd be printing another near 20% return this year. I thought we'd be closer to maybe the 8 and 10 range, particularly after 2 preceding years of 20. But kind of what are you starting to look at for next year and kind of in your just your idea box?
Well, one thing that's not worked this year is seasonality. The sell in May and go away just ended a couple days ago, and I'm starting to get a lot of people that say, "Oh, now we're in the best 6 months out of the year," and we'll see. I mean, we've seen pullbacks. I think it was 2018 that we saw a nasty fourth quarter, and the Fed had to pivot. And we got really oversold then, and that I remember that really well. I was in Carl Quintanilla from CNBC. I pinged him, and I was sick on a family vacation right before Christmas in London in a hotel room, and I'm just looking at my laptop, and I just said buy everything, and he always credits me on that, but it was really true. We really did get oversold, and it was the seasonally best period. Bubbles don't deflate, they pop. And we don't necessarily have a bubble in the whole market because we're starting to see a lot of stuff, trickle down. But the bubbles in AI could pop. And that could be Nvidia having a problem because China can say, we just like DeepSeek, you can have another type of thing like that where we're running the same models for a fraction of the price, and that sort of blows a hole in the CapEx world there. And that's something I could see. Politically, anything can happen politically, the tariffs, everything, I don't know. But looking into 2026, I think we're going to have more of the same. It's going to be difficult to continue the strong momentum that we've had so far, unless we get a really decent sized correction. And that could be, maybe that's going to be in January or February. February is always, March, difficult months. But I think that you have several names that pose risk. I think Tesla is one that poses risks. Their business is under pressure. They just had a pull forward with all the demand, with EV subsidies ending, $1.5 trillion market cap. If they start to show losses, which is not unheard of, and they don't have flying cars, and the robo-taxis aren't working, that could cause some real worries there as well. And again, Nvidia, they report in a couple of weeks. Everybody knows it's going to be great. They've sold off after earnings several times in this cycle because the guidance wasn't, big enough. And you run into the diminishing percentage gains of what you can guide to. And it'll be great, but it just may not be good enough to continue this. So I think 26 is going to be more challenging. You've got the Fed that's going to be involved, and the Fed's cut 4 or 5 times so far, including last year, because you got to really count that as well. So if you also, if rates don't go down, that's also a catalyst that I could see being a real problem, because you talked about the small cap stocks. They're dependent on rates going down. The housing sector is dependent on rates going down, and not Fed funds rates, but Treasury rates.
Right.
And that is a concern. So, one way of fixing the bond market and seeing rates go down is an equity pullback or then some. So that you can fix one problem and create another. But and I thought that was going to happen in the first quarter. I thought Trump was going to allow the stock market to sell off and be lower, and rates would go lower. And then again, you can have any sort of geopolitical thing. You still have
Sure.
the Russia, Ukraine, that's still a mess. The Mideast seems a little cooler these days, which is good. Venezuela, I mean, who had
Right.
that one?
Right.
And anything else could happen. But the problem is when everybody is all in, they're all levered, and they're all fully complacent with sentiment being as high as it is. It doesn't take an earthquake or a nuclear bomb to prick the bubble. It could be something very minor, and where people just say, "Oops,
Yep.
time to sell," and that might be all it is.
Well, and that's kind of the thing I've been telling our listeners is that, this is very, the market's like a theater, and everybody's very crowded in the theater right now. And all it takes is somebody to fire. And the problem is the exits get very narrow very quickly when everybody's trying to exit the market at once. So, from our perspective, it's just, you can remain invested, but just sit a little bit closer to the exit. Have a little bit more defense in your portfolio. Add some treasury bonds in your portfolio as a defense measure. Sure, yes, it's going to limit your upside gains, but if this market does roll over and you have a correction, you're going to be glad you had a little bit of insurance in your portfolio.
Yeah, I not to sound politically incorrect, but everybody in the theater.
Mm-hmm.
Since they're levered, they're obese. And so trying to get these obese people out through the doors makes it even more crowded. It's not like, everybody's just going to be there, walking out.
Yeah.
Levered, I mean, we've seen it before. We've seen the leverage ETFs blow up. We've seen the volatility ETFs blow up. And there's no bid. There's no dip buyers there when you're levered and you need to get out because let's say you have one of those lovely 5X ETFs and that one stock goes down 10%. You're down 50%.
Right.
You're not happy. You can't get out ahead of everybody else because you're bigger than the doorway. Oh God.
Yeah. I'm leaving that in there. Yeah. That's awesome. Hey, Thomas, we really appreciate your time today. Thomas Thornton, he is the founder and president of Hedgefund Telemetry, LLC. Be sure and check him out on his website, hedgefundtelemetry.com. He's going to be running a special on his services here for the holidays, so keep your eye out for that at the website. And again, just a good source of information. Tom, it's been so much fun today. Definitely want to have you back here soon, particularly if the markets do kind of work out the way they think we'll do. We'll follow up and get everybody up to speed on what's happening then.
Well, thanks, Lance. I follow your work. I watch your videos, your live videos, yours with Adam on the weekends. I find your advice really valuable, and I think that your clients should be very grateful for your just unending service that you provide. And it's not telling people what they want to hear always. Right. And I think that's really very important. And I try to do that myself. Sometimes I'm not telling people what they want to hear and say, oh yeah, it's buy Nvidia, triple levered.
It's all good. Don't worry about it. Hey, Tom, I appreciate the sentiment very much, and the same goes to you, and I do appreciate your time today very much. So be sure and get by our website, realinvestmentadvice.com. Watch this video. Be sure and like and subscribe to this channel. Share this video with your friends as well. I think it'll be a big help for everybody. So like and subscribe to the channel. Share the video, all at realinvestmentadvice.com. And, of course, we'll see you back here for the next interview series coming up on The Real Investment Show. Have a great day.